85% of you listening right now believe the cash sitting in your bank account, checking or savings, is yours. You believe it's sitting there, patiently waiting for you to withdraw it. You believe the Federal Deposit Insurance Corporation, the FDIC, is your silent bodyguard, protecting your cash up to $250,000. That is the great lie, and it is the most dangerous, politically convenient lie ever told to the American middle class. I'm here to tell you the truth, the dark financial truth that your bank statement hides from you. The moment you push that cash across the teller's desk or hit the confirm transfer button online, that money, legally, is no longer yours. It becomes the bank's property. What you hold in your hand is not a receipt for money ownership. It is a piece of paper, a digital entry, confirming that you are now an unsecured creditor of the bank. Think about that for a second. You are lending your money to the bank, and, like any loan, there is risk. Most people think their checking account is like a safe deposit box. Money goes in, sits there, you take it out when you need it. Wrong. Your deposit is the fuel that banks use to make their real money. They take your dollar, lend out 90 cents of it, and use the rest to gamble in the financial markets. They are highly leveraged, high-risk enterprises, and you, the unwitting depositor, are the first line of defense when they fail. The entire system, my friends, is built on a lie of temporary trust. You might be thinking, Ken, this is just financial semantics. It's always been this way. Yes, it has. But now, for the first time in modern American history, the banking system has the legal framework, the political will, and the looming crisis to convert that technicality into actual confiscation. This isn't a conspiracy theory. This is documented fact, passed into law by Congress, signed by presidents, and published in the footnotes of international regulatory bodies. The money you thought was safe is actually collateral for the next financial disaster. And the next disaster is already here. It's sitting on the balance sheets of your regional banks, waiting for the clock to hit 2026. Before we dive into the specific crisis, let me show you what happens when a government decides the system is more important than your savings. Because what is coming to America has already happened in Europe. It was a perfectly executed, legal grand theft auto of cash. Let's rewind the clock. Forget the American financial circus of 2008. Forget Lehman Brothers. That was a bailout. That was the government, the U.S. Treasury, riding in like a white knight, using taxpayer money, your money to save the corrupt big banks. The public screamed, the politicians swore, never again. But history, my friends, is less about avoiding mistakes and more about upgrading the tools of theft. We're not talking about a bailout anymore. We're talking about a bail-in. Picture this, Cyprus, a small, sunny island nation in the Mediterranean, a member of the European Union, modern financial system. Everything seemed perfectly fine until the third week of March in 2013. The Cypriot banks, over-leveraged and stuffed with bad investments, were facing a catastrophic collapse. The EU and the International Monetary Fund, the IMF, refused the traditional bailout. They were sick of paying for rich bankers' mistakes. So they tried something new, something chillingly efficient. They decided to make the banks save themselves by taking their creditors' money. And guess who their biggest, most convenient creditors were? The depositors. That Friday, everything was normal. People went to the ATMs, deposited their paychecks, and planned their weekends. Over the weekend, behind closed doors in Brussels and Nicosia, the government enacted emergency legislation. They passed a law that legalized the confiscation of private savings. When the banks were scheduled to reopen on Tuesday, the government announced the new rules. Anyone holding more than 100,000 euros in their bank account, whether a business, a retiree, or a successful professional, would have their funds above that threshold seized. Let me give you the number, the exact official number that should haunt your sleep. 47.5%. If you had 200,000 euros in the bank on Friday, thinking you were financially prudent, you woke up Tuesday morning and your bank balance was suddenly 150,500 euros. The bank, your supposed partner, took 47,500 euros. Just took it. Zero warning. Zero consent. Zero negotiation. Life savings, retirement funds, operating cash for small businesses gone, vanished into the black hole of bank capitalization. It was a perfectly legal, state-sanctioned financial murder. The government didn't use taxpayer money. They didn't increase the national debt. They simply used your deposits, which legally were the bank's liabilities, to recapitalize the failed institutions. This wasn't some backwater, banana republic default. This was a sophisticated financial state in the heart of Europe. It was a proof of concept for the financial elite globally. It showed that when the next systemic crisis hits, the path of least resistance is not to annoy the public with a bailout, but to quietly liquidate the large depositors with a bail-in. Now, every time you hear a politician or a bank executive talk about financial stability, you need to remember that number, 47.5%. That is the price of their stability. You think that's just a tiny island in the Mediterranean? You think that could never happen in the land of the free, the home of the brave, the USA. You are wrong. Not only can it happen here, but the legal framework to make it happen was installed immediately after the Cypriot experiment. Congress prepared the tools for the next great American cash grab. The Cypriot crisis was merely the live rehearsal. The main event needed a better stage, better actors, and most importantly, a fully rigged legal system. Enter the Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, 2 years before the Cyprus event was even fully conceived. After the rage of 2008, Congress had to look like they were doing something. They sold Dodd-Frank to the American people as the banker leash. The law that would finally end too big to fail and prevent another taxpayer bailout. Sounds fantastic, right? Responsibility, accountability. But look closer. Buried deep inside the technical language, specifically in Title II of the Act, is the Orderly Liquidation Authority, or OL. This OLA gives the FDIC the unilateral power during a systemic financial crisis to seize a failing bank and restructure it. And the key term, the absolute dagger aimed at your savings, is the power to convert unsecured debt into bank equity. I'll strip away the jargon for you. This means they can legally take your cash, deposit your unsecured debt that the bank owes you, and instantly convert it into shares of stock in the failing bank. Your money vanishes from your account. And what do you get in return? A worthless stock certificate for a bank that is about to declare bankruptcy. You went from a creditor owed cash to a shareholder stuck with a liability. It's the ultimate financial switcheroo, and the legislation allows the FDIC to do this without your consent, without a court order, and over a single, terrifying weekend. This is the ultimate evolution of financial theft. In 2008, they stole from the taxpayer. Now, they've simply changed targets. They are stealing directly from the depositor. They call it making the banks responsible for their own failures. We call it the government-sanctioned grand theft of private wealth. Now, let's address the elephant in the room, the $250,000 FDIC insurance limit. This is your comfort blanket. It is designed to keep you sleeping soundly. But let's talk math, the cold, hard math that banks love and the public ignores. The total amount of cash deposits in US banks is currently north of $18 trillion. Now, let's look at the actual cash held in the FDIC Deposit Insurance Fund. It hovers around $128 billion. Do the division. The FDIC fund covers less than 1% of total US deposits. That little safety limit of $250,000 only works if one, maybe two, banks fail quietly. If 50 or 100 regional banks buckle simultaneously, the systemic crisis we are currently speeding toward that $128 billion will be exhausted before the first commercial break on Monday morning. News. And when the fund is exhausted, what happens? They certainly can't print their way out without causing hyperinflation that makes your cash worthless anyway. They use the OLA, the Orderly Liquidation Authority. The government has already telegraphed the play. They will bail in the large accounts, legally. And don't be fooled, every major US bank has filed a living will, their resolution plan with the FDIC. These plans, required by Dodd-Frank, detail exactly how they would restructure if they fail. And every single one of them includes bail-in provisions. They aren't hiding this. They just made it so technical, so boring, and so buried in legalese that nobody bothers to look until the ATM. It stopped working. The legal framework is in place. The historical precedent has been set. Now we connect the dots to the current reality. The clock is ticking down to late 2026, and the detonator is hidden inside the commercial real estate sector. This isn't about some abstract risk. This is about cold, hard, expiring debt. Between now and 2027, over $1 trillion in commercial real estate loans will mature and require refinancing. Most of these loans were issued between 2016 and 2021, when the Federal Reserve had interest rates pinned near 0.5%. That was the golden age of cheap money. Now, that golden age is a coffin. Thanks to the Fed's frantic fight against inflation, the benchmark interest rate has soared. Owners who could service their debt at 3% interest are now being forced to refinance at 7% or even 8%. Their debt payments have effectively doubled. Simultaneously, the collateral for those loans, the office buildings, the shopping centres, the downtown towers, have cratered in value. Why? The work-from-home phenomenon. Demand for office space has dropped by as much as 30% to 50% in major metropolitan areas. Let's be clear about the math of doom. The property value is down, and the cost of servicing the debt is up. The owners cannot refinance, and the buildings are not generating enough rent to cover the new higher interest payments. The result is unavoidable: a wave of mass defaults. So, who is holding this ticking time bomb? Not the mega banks like JP, Morgan or Bank of America. They offloaded much of this risk. The bomb is sitting squarely on the balance sheets of hundreds of regional banks and smaller institutions across America. These are the same banks where your local business owner keeps their payroll account. These are the banks that collapsed into the spotlight in 2023. Think back to the Silicon Valley Bank failure in March 2023. That was a classic bank run, triggered by rising rates and poor asset management. It didn't take weeks. It didn't take days. It took 48 hours. Depositors pulled $42 billion in a single day. The bank went from solvent to seized overnight. SVB was one bank. Now, imagine 50 to 100 regional banks simultaneously facing the commercial real estate cliff. They can't sell the buildings because the market is paralyzed. They can't raise capital because their stock is crashing. And they certainly don't have enough capital on hand to absorb a 40% write-down on their entire CRE portfolio. The panic will spread faster than a rumor on Twitter. When the run starts, the FDIC, with its measly $128 billion, will be overwhelmed instantly. They won't have time to find a buyer for every failing bank. They won't have the cash to make every depositor whole, even those under the $250,000 limit. The only tool left in their political and legal arsenal is the bail-in. It is fast, it is clean, and it uses your money, the depositor's money, to plug the hole. The only people who suffer are the customers, not the taxpayers, and certainly not the executives who created the mess. And the commercial real estate crisis isn't the only stress point. Look at consumer debt. Credit card debt is at an all-time high, exceeding $1 trillion. Auto loan defaults are rising rapidly. Student loan forbearance ended, throwing millions of consumers back into financial distress. Every category of consumer stress translates into losses for the banks holding that debt. It all adds pressure to the regional banking system already sitting on the CRE bomb. The system is not sound. It is a house of cards constructed from cheap debt, and the wind, the high interest rate wind, is finally blowing it over. The regulators, the FDIC, the Federal Reserve, they are watching the same data. They know the storm is coming. The wave of CRE maturities hits its peak right in late 2026. This is why they have been quietly, meticulously preparing their resolution plans, their bail-in procedures. This isn't a future possibility. This is the documented strategy for handling the next inevitable crash. If you have a business account with operating capital, if you are a successful professional who keeps more than the FDIC limit in your accounts, you are not safe. You are not a customer. You are a target. Your excess cash is now considered the collateral needed to keep the lights on at the next failing bank. The time to act is now, before the commercial real estate bomb detonates and the OLA is invoked. If you thought this bail-in framework was just an American regulatory mistake, you are giving Congress too much credit. This is not a mistake. It is a coordinated international policy. The legal theft of your deposits is the global standard for financial stability. The world's central bankers and finance ministers learned a harsh lesson in 2008. The public will accept economic suffering, but they will riot if you spend their tax money to save corrupt bankers. So, the solution was elegant, cynical, and globally consistent. Change the law so the depositor pays the bill instead of the taxpayer. This policy was formalized by the Financial Stability Board, the FSB. The FSB. is an international body of regulators, including representatives from the US Federal Reserve, the US Treasury, and other major financial powers. In 2013, right after the Cyprus experiment provided the perfect, bloody proof of concept, the FSB published key standards recommending that all major global economies adopt the bail-in as the default mechanism for resolving failing banks. The following year, in 2014, the G20 nations, the world's 20 largest economies, formally agreed to implement these FSB standards. Let that sink in. This isn't a shadow government. This is a public agreement among the world's most powerful nations to create a framework where bank debt, including your unsecured deposit, can be converted into bank equity during a crisis. We have the official documents to prove this. We have the 2012 paper jointly published by the FDIC and the Bank of England, the British Central Bank, explicitly detailing the use of bail-ins for resolving major financial institutions. This means if you decide to pull your money out of Bank of America and send it to a bank in Toronto, Canada, or Frankfurt, Germany, you are still exposed. Canada passed its own bail-in laws. Europe, through its Bank Recovery and Resolution Directive, mandated bail-in frameworks across all member states. The financial system has built a cage around you, and that cage extends across every single major, modern banking jurisdiction on the planet. This is the new political reality. You are on your own. The politicians get to look tough on Wall Street by avoiding a bailout, and the bankers get their balance sheets cleaned up using their customers' cash. It is a win-win for the powerful, and a catastrophic loss for the prudent saver. Your protection is now your sole responsibility. You cannot outsource your financial security to a regulator or a government that has already legalized your confiscation. The question is no longer if the next crisis will hit or if the bail-in will be used. The only question is, what are you going to do about it? The system is rigged. The law is written. The crisis is coming. You have been warned, and now you must act. This is not about panic. This is about prudence. We are moving money from a failing, rigged system into assets that cannot be legally seized. Here are 10 immediate, decisive steps to prepare for the 2026 bail-in deadline. Action 1. Calculate your exposure. Add up every dollar you have in checking accounts, savings accounts, and certificates of deposit CDS across every single institution. If that number exceeds $250,000, you are directly exposed to the bail-in risk for the excess amount. Know your enemy, the excess deposit. Action 2. Deconcentrate your cash. If you hold $500,000 in one bank, you are a prime target. Immediately open accounts at different, unrelated institutions. Spread that $500,000 into 2 or 3 different banks, the FDIC. Limit of $250,000 is per institution, not per person or per branch. Play the rules they set. Action 3. Audit business accounts. Business owners, this is critical. Your operating accounts often hold far more than the $250,000 limit. Every penny over that limit is considered disposable capital for the bank in a crisis. Keep only the necessary cash for 1 to 2 weeks of payroll and immediate expenses in your bank account. Action 4. Invest in Treasury bills, the safest move. This is the ultimate defensive play. Move excess cash, the money you don't need for the next 6 months, out of the banking system and into US Treasury bills, or T-bills. T-bills are backed by the full faith and credit of the US government. They are not bank deposits. They are not liabilities of the bank. They are immune to the bail-in. You can buy them directly through Treasury Direct, the government's own website. Action 5. Utilize Treasury money market funds. For slightly faster liquidity than T-bills, open an account at a major brokerage like Fidelity, Schwab, or Vanguard. Invest your excess cash into a Treasury money market fund. These funds exclusively hold short-term government securities. They are not bank deposits and are therefore not subject to the bail-in laws. Action 6. Acquire physical assets, gold and silver. Every serious financial survivalist owns some physical gold and silver. These are assets that cannot be frozen, cannot be digitized, and cannot be bailed in. They are outside the financial system entirely. They are the ultimate insurance policy against systemic failure and currency debasement. Start small, but start now. Action 7. Prioritize real assets. If you have a significant cash pile, use it to invest in real estate or other tangible assets that hold intrinsic value. A house, A piece of land or a managed property cannot be converted into worthless bank stock by the FDIC. It is a physical, unseizable store of wealth. Action 8. Review retirement accounts. Check where your IRAS and 401ks are held. If they are held directly with a bank as part of a cash sweep or CD program, they might be vulnerable. Move them to a separate brokerage or custodian account where they are protected as segregated assets. Action 9. Educate your elders. Your parents and grandparents, who lived through eras of trust and higher interest rates, are highly susceptible. They often keep large sums in CDS at a single, trusted local bank. Explain the bail-in risk to them. Help them execute Action 2 and Action 4. Your inaction could cost them their retirement. Action 10. Set up high-value alerts. Go into your bank's online portal and set up text or email alerts for all transactions exceeding a nominal amount, say $1,000. You need to be immediately notified of any unusual activity, transfer restrictions, or balance changes. In a crisis, speed is the only defense you have. You have 12 to 18 months until the commercial real estate cliff hits its peak. Do not trust the institutions that have already legalized their right to take your money. Take back control. Act now. Let's be brutally honest one last time. The bail-in is not a bug in the system. It is a feature. It is the ultimate insurance policy for the financial elite. It allows them to survive the crash without having to face the angry taxpayer or the political fallout of a massive government bailout. The only party paying for the party is you, the depositor. We have established the undeniable truth. 1. Your deposit is a loan to the bank, making you an unsecured creditor. 2. The Dodd-Frank Act legally enables the FDIC to seize those funds and convert them into worthless bank stock. 3. The commercial real estate debt cliff, peaking in 2026, is the precise trigger they need to invoke the Orderly Liquidation Authority. The government will not save you. The FDIC insurance fund is a joke, a tiny fraction of the deposits it is supposed to protect. When the crisis hits, the only people who will be protected are the people who saw the warning signs and took decisive action. The people who divorced their banks and moved their wealth into tangible assets like T-bills, gold, and real estate. Don't be the citizen who lines up at the ATM on a terrifying Monday morning, only to find their life savings have been legally converted to trash. Don't be the business owner who misses payroll because the government decided the system needed your cash more than your employees did. You have the knowledge, you have the plan. The clock is counting down. If this video woke you up, then your first action is this. Share it immediately. Your family needs to see this. Your business partners need to understand this. Do not let the people you care about be financially liquidated in silence. Thanks for watching. Stay informed, take action. And whatever you do, do not keep more money in banks than you can afford to lose.